Trading is not a game. It is not a hobby. It is not something you do on your lunch break while scrolling through charts and sipping overpriced coffee. Trading is a business, and if you want to survive, let alone thrive, you need to treat it as such. This means you have to start by rewiring the way you think. Because the cold truth is that most people who come into trading bring with them the exact wrong mindset. They think it's about excitement, fast profits, and guessing the next big move. What they don't realize is that behind every professional trader on Wall Street, there is discipline, patience, and a ruthless commitment to structure. The first shift in mindset is understanding that trading is not about being right. In fact, professional traders lose trades all the time. They don't care about win rates the way amateurs do. They care about managing risk, about cutting losers fast and letting winners run. They care about consistency, about showing up to the market day in and day out with a process that is defined, repeatable, and statistically sound. Amateurs obsess over the outcome of the next trade. Professionals focus on the outcome of the next thousand. That's the key difference. If you still look at a single trade as make or break, you are thinking like a gambler, not a trader. And this is where most fail before they even begin. The market is a complex, chaotic system. It doesn't owe you anything. It doesn't reward effort. It only responds to skill, patience, and emotional control. You can read all the books you want, take all the courses available, and memorize every pattern ever discovered. But if your mindset is off, you will burn your account faster than a match in a hurricane. Now let's get brutally honest. Trading for a living means putting food on the table with your decisions. It means your success is not optional. There is no backup plan. And that requires a level of mental toughness most people have never trained for. When you sit in front of the screen, there is no boss to yell at you, no client to answer to, just you, your rules, and your capital on the line. And that kind of freedom is dangerous if you're not ready, because without discipline, freedom becomes chaos. And in trading, chaos equals loss. So how do the pros do it? They start by building habits that mirror the way institutional players operate. They prepare before the market opens. They review charts not to predict but to observe. They journal their trades. They set hard rules and follow them like law. They do not chase moves. They do not overtrade. They do not revenge trade. Every decision is measured, deliberate, and backed by logic. Because they understand this game is not about adrenaline, it's about edge. And that edge doesn't come from finding the perfect strategy. It comes from executing a simple strategy with military-grade consistency. That's the part no one wants to hear. Everyone is looking for the holy grail setup, the one signal that always wins. But the real professionals have already realized that the market is not about certainty. It's about probabilities. They're not trying to be right all the time. They're trying to make more when they are right than they lose when they are wrong. That's it. Risk 1 to make 3. Risk 2 to make 5. Stack the odds in your favor. And let the math play out over hundreds of trades. To get there, you need rules, not loose ideas, not feelings, not opinions, but rules written down, tested, and obeyed without exception. When do you enter? When do you exit? What defines a setup? What defines a stop? Where is your edge? If you can't answer those questions in less than 30 seconds, you are not ready to trade. Because in the heat of the moment, your emotions will always betray you. You'll hesitate, you'll overthink, you'll panic, and the market will punish you without mercy. This is not hyperbole. This is reality. Every professional trader has paid that tuition to the market. Every one of them has taken the gut-wrenching losses, stared at the screen in disbelief, questioned everything. But the difference is they learned, they adapted, they took the pain and turned it into process, and eventually process turned into consistency, consistency into confidence, and confidence into freedom. But it all starts with mindset. The right mindset kills ego. It removes the need to be right. It replaces hope with logic. It treats trading like a business, where risk is managed and decisions are measured. It understands that capital preservation is rule number 1, and that opportunity is abundant if you can survive long enough to capture it. Let's talk about survival. Most traders blow up not because of strategy flaws, but because they fail to protect capital. They get emotional, they double down, they widen stops, they chase losses. These are not market errors. These are psychological errors. and they are deadly. A trader can have a system that works 70% of the time, but if they lose their head on the 30%, it doesn't matter. One mistake can erase a month of good decisions. One undisciplined trade can set you back weeks. That's why the pros never risk more than a small percentage of their capital on any one trade. They understand that defense is everything. Offense is optional. If you lose small, you can survive. If you survive, you can grow. And if you grow, you can scale. That's the real compounding secret no one talks about. It's not just returns that compound, it's discipline. Every time you follow your rules, you strengthen the neural pathways that make those rules easier to follow next time. Discipline builds discipline. And eventually, it becomes your default operating system. Now let's zoom in on a real day in the life of a professional trader. It begins before the sun rises. They are not scanning TikTok or Discord for trade ideas. They are scanning charts they've been watching for weeks. They already know what levels matter. They already know which sectors are strong and which are weak. They're not chasing momentum. They're waiting for structure, for setups that match their criteria. They're patient, even bored at times. But when the moment comes, they execute without hesitation. And then comes the hardest part, doing nothing. Because trading is not just about entries, it's about exits. It's about managing trades, adjusting size, cutting losers quickly, letting winners breathe. Not staring at the screen all day, but trusting your plan. Most of all, it's about not forcing action when there is none to take. Pros understand that cash is a position, that no trade is better than a bad trade, that discipline is not only about doing, but about waiting. Waiting is underrated. Waiting is where the real money hides. Anyone can enter a trade. Few can sit on their hands when the market is directionless. Fewer still can walk away from the screen on a slow day and live to fight another. But those who do, win. Because they preserve mental capital, they avoid decision fatigue, and they save themselves for the moments that matter. And those moments do come. Trends emerge. Volatility spikes. Patterns align. And when they do, the trader who's been watching, waiting, preparing, strikes. Not out of emotion, not out of FOMO, but because their rules tell them to. Because the edge is there. And they don't hesitate, they act. That is what separates a trader from a bystander. Action with intention. There is one more thing that cannot be overstated: your environment. Trading alone, isolated, disconnected from others who speak your language, it's a recipe for burnout. You need a network, a circle, not for signals, not for hand-holding, but for accountability, for perspective, for sharpening your edge. The best traders I know have mentors, peers, even rivals. People who challenge them, check their blind spots, push them to level up. You can't do this alone, not for long. The market will find your weaknesses. Your circle helps you fix them. And journaling. If there is one habit that could transform a struggling trader into a consistent one, it's journaling. Not just writing down trades, but writing down thoughts, emotions, mistakes, patterns, questions, insights. This is how professionals learn faster than everyone else. They don't just trade, they study themselves. They know their tendencies, their triggers, their emotional cycles. And they build systems not just to control the market, but to control themselves. Because here's the truth that few want to admit. The real enemy in trading is not the Fed, not the algos, not the whales. It's you, your fear, your greed, your ego, your lack of preparation, your impatience, your refusal to follow your own rules. That's the real battle. And the sooner you accept that, the sooner you can start winning it. Trading for a living is not about talent. It's not about IQ. It's about emotional mastery. It's about showing up every day like a professional. Not because it's fun, but because it's your job. Not because you're inspired, but because you're committed. You will not win every trade. You will not avoid every mistake, but you will learn. You will adapt. And over time, you will build something few people ever do. An income stream entirely under your control. A skill that prints freedom. But first, you have to stop thinking like an amateur. Stop chasing signals. Stop looking for shortcuts. Start acting like a business. Start treating capital like oxygen. Start building a process you can trust even when emotions are screaming. That's when things change. That's when you cross the invisible line between playing the game and owning it. Because in the end, the market doesn't care about you, but it does reward those who respect it, who approach it with humility, who put in the work, who survive long enough to thrive. And if you can do that, if you can master your mind, protect your capital, and trust your process, you won't just trade for a living. You'll live because you trade. Before you can trade effectively, you must learn to listen. The market speaks in price. It does not whisper. It does not shout. It simply moves up, down, sideways. Price is the raw data of human behavior in real time. And just like a trained doctor can look at a chest x-ray and see pneumonia while a layman sees only gray and white fog, the professional trader reads a chart and sees fear, greed, exhaustion, accumulation. Price is the voice. The chart is the canvas. Your job is to become fluent in the language of price action. Forget about trying to predict the news. Forget about chasing earnings reports or economic calendars. Those are distractions unless you run a hedge fund with teams decoding macroeconomics. What you need to focus on is the only thing that matters: how the market reacts, not what should happen, what is happening. And the first place to look is the chart, because the chart never lies. Every candle tells a story, not of machines or systems, but of people, of decisions, of risk tolerance and emotional thresholds. A long wick on top? That was rejection. Buyers pushed it up, but sellers said no. A strong close at the top of a green candle? That was aggressive buying. A tight range over several hours after a sharp move? That is consolidation, a breath before the next sprint. The patterns that form on your screen are not just technical structures, they are psychological footprints. Support is not some magical line. It is a zone where buyers have proven they are willing to defend. Resistance is where sellers are eager to unload. Trends form when the crowd aligns in direction. Reversals emerge when sentiment bends the other way. Every shape on your chart is a reflection of group behavior under stress or confidence. This is why professional traders study price action like linguists study dialects. They do not just memorize patterns, they observe context. Context is everything. A bullish engulfing candle at the top of a parabolic run? That is not strength, that is euphoria ready to collapse. A doji at a key support level after weeks of selling? That may be the first sign of reversal, but it only matters when you place it within the bigger picture. Start with structure. Structure is the skeleton of price behavior. It tells you where the market has memory. Look left. Always look left. Where has price reversed before? Where did it accelerate? Where did volume spike? These are your areas of interest, not because the lines themselves hold power, but because other participants see them too. And when enough traders react to a level, it becomes self-fulfilling. Support and resistance are not thin lines. They are zones. Think of them as battlefields where buyers and sellers have fought before. Watch how price approaches these zones. Is it slowing down? Is volume drying up? Are candles getting smaller? These are clues. Price action gives you signals long before the news confirms anything, but you have to watch, patiently, without bias. Next, observe momentum. Momentum is not just speed, it is conviction. A strong impulsive move with little pullback tells you that one side is in control. If buyers are hitting every dip with force, you are in a trend. If every rally gets slammed down quickly, you are in a downtrend. Momentum is the emotional weight behind price. It reveals who is more aggressive, and aggression drives direction. But here's the catch. Momentum fades, trends end, and the earliest signs of reversal are often subtle. This is where indicators can help, not to predict, but to confirm. Let's be clear. Indicators are not magic. They are derivatives of price, nothing more. But when used intelligently, they can give you added clarity. The key is to use them as tools, not crutches. Start with the exponential moving average, EMA. Unlike the simple moving average, which gives equal weight to all candles in a look-back period, the EMA gives more weight to recent price. This makes it more responsive to change. For momentum traders, the 20 EMA is gold. In an uptrend, price tends to ride above the 20 EMA. When it touches and bounces, that's confirmation of strength. When it slices through and fails to reclaim, the structure is breaking down. Use EMAs to define trend. A rising 20 above a rising 50 tells you the path of least resistance is up. A declining 20 below a declining 50 tells you the trend is down. But more than that, the space between EMAs shows compression or expansion, energy buildup or release. When the EMAs converge after volatility, you are looking at potential breakout zones. But don't stop at trend. Look at MACD, the moving average convergence divergence. It is built on EMAs, but gives you a visual of momentum shifts. When the MACD line crosses above the signal line, bulls are gaining control. When it crosses below, bears are pressing harder. Combine that with the histogram, which measures the distance between the lines, and you get a powerful visual of acceleration or deceleration. MACD is not for pinpoint entries, it is a context tool. If price is pushing into resistance while MACD is weakening, that's divergence. And divergence often precedes reversals. Not always, but often enough to pay attention. Think of MACD as a cardiogram. It tells you whether the heart of the trend is beating strong or fading out. Then we come to the force index. This is one of the few indicators that combines price, direction, and volume. Developed by Dr. Alexander Elder, it captures how much strength is behind a move. A rising force index with volume confirms trend. A declining index on a price rally tells you the move is losing steam. Unlike MACD, the force index can be extremely short-term or long-term depending on the look-back period. It is versatile. Use it to confirm breakout attempts or to expose hidden weakness in price spikes. But let's get one thing clear. Never overload your chart. One or two indicators are enough. Any more and you are flying blind in a storm of conflicting signals. Always return to the price. Indicators are assistants. Price is the boss. Trust what price tells you. Watch how it behaves at key levels. See how it responds to volume surges. Study the wicks, the bodies, the spacing. Price action is not noise. It is the market speaking. Are you listening? Reversals do not happen randomly. They form patterns. Look for lower highs in an uptrend. Look for higher lows in a downtrend. These are early signs that momentum is shifting. Watch for compression. Price coiling in tight ranges. That is energy being stored. And energy stored eventually becomes energy released. The tighter the coil, the more explosive the move. Now, reversal signals are only half the story. You need confirmation. And this is where multiple timeframe analysis becomes essential. A setup on the 5-minute chart means nothing if the 1-hour chart is against you. Always trade in the direction of the higher time frame unless you are scalping. Use the larger chart to identify structure. Use the smaller chart to time entries. Let's say the 4-hour chart shows price bouncing off a major support level. That's your context. Now, drop to the 15-minute chart. You see a bullish engulfing candle followed by a consolidation range. You check a MACD and see the histogram turning up. The force index is green and rising. The 20 EMA is flattening and beginning to turn. You now have structure, signal, and confirmation. That is a high probability setup. If trading is a war, then capital is your ammunition. And when you run out, the game is over. It doesn't matter how brilliant your strategy is. It doesn't matter how accurate your signals are. If you fail to manage your risk, the market will take everything from you, and it won't even blink. Risk management is not exciting. It's not flashy. It won't make your Instagram feed look glamorous. But it's the only reason the top traders are still in the game. Anyone can get lucky on a few trades. Anyone can double their account during a hot streak. But professionals don't play to get lucky. They play to survive. And survival requires discipline at a level most retail traders never reach. Here's the brutal truth. You can be right 6 times in a row and still blow your account on the 7th if you ignore position sizing. This happens every day. Traders string together a few wins. Their confidence grows faster than their discipline, and suddenly they're risking 10 or even 20% on one perfect setup. That trade goes wrong, as trades sometimes do, and boom, half the account is gone in 60 seconds. That's not bad luck. That's poor management. Real traders play the long game. They understand that no single trade matters. What matters is the next 100, the next 500, the next 1,000. In that game, the most important skill isn't analysis, it's capital preservation. Enter the 2% rule, made famous by Dr. Alexander Elder. It's elegantly simple. Never risk more than 2% of your trading capital on any single trade. Not 2% of your account size, not your position size, but 2% of your capital at risk. That means your stop loss, not your entry. Let's put that in perspective. Suppose you're trading with a $100,000 account. 2% is $2,000. That's the maximum amount you are willing to lose on a single trade. Not the amount you invest, but the amount you put in harm's way. If your trade idea requires a stop loss of $5 per share, then you can afford 400 shares. Simple math. That's how professionals think. Not in terms of how much they can make, but in terms of how much they can afford to lose. The 2% rule is not sacred. Some traders go lower, 1%, even half a percent if they trade frequently. But the principle never changes. You size your trades based on your risk tolerance, not your profit dreams. Because the goal is not just to grow, the goal is to stay alive. And that brings us to a core concept that separates traders from gamblers: expectancy. Expectancy is the statistical engine behind every successful trading system. It's the formula that tells you whether your method is profitable over time. The equation is simple but powerful. Expectancy, win rate, Kank's average win minus loss rate, average loss. Let's break that down. Suppose you win 50% of your trades. Your average win is $3,000. Your average loss is $1,000. Plug that in. 0.55 3,000 minus 0.5 times 1,000 equals 1,000 Chitrul. That means on average, you make $1,000 per trade. That is positive expectancy. That is an edge, and edge is the difference between a professional and an amateur. Now here's the kicker. You can have a win rate as low as 30% and still be wildly profitable, as long as your winners are bigger than your losers. That's why cutting losses quickly and letting winners run isn't just a saying. It's mathematics. Risk 1 to make 3. That's the game. And once you understand that, everything changes. You stop obsessing over being right. You stop feeling like a failure when you take a stop. Because the goal is not to win every trade. The goal is to execute every trade within your system. If your setup says enter, you enter. If it says exit, you exit. No questions. No second guessing. The only thing you can control is your process. And your drawdown, that's the silent killer. Drawdown is the distance between your account's peak and the current equity value. If you hit a high of 120,000 and drop to 100,000, you're in a 16.6% drawdown. Here's the part most traders don't understand. To recover from that drawdown, you don't need to make 16%, you need to make nearly 20. And if you drop by 50%, now you need to double your account just to break even. That's the math most people ignore. That's why risk management is not optional. It's the foundation. Blowouts aren't just emotionally devastating. They're mathematically crippling. Every large loss makes the climb steeper. That's why professionals cap their drawdowns. 10% max for some, 5% for others. When that line is crossed, they stop trading. Not because they're afraid, but because they respect the math. Let's talk about risk to reward. If your setups only offer a 1-to-1 reward to risk ratio, you need to win more than 50% of the time just to stay afloat. But if your setups offer 3-to-1, you can be wrong 65% of the time and still be profitable. That's edge. That's how traders survive the inevitable losing streaks. And yes, losing streaks are inevitable. Even the best traders in the world go through cold spells. The difference is how they handle them. Amateurs increase size after losses, hoping to win it back. Professionals reduce size. They go defensive. They protect capital. They wait for conditions to align again. They know that trading is not about constant action. It's about precision, patience, discipline, and above all, risk control. You are not in the market to win every trade. You are in the market to manage risk. Winning trades are simply the byproduct of disciplined execution over time. That mindset shift is the foundation of long-term success, and it separates the trader who survives from the one who disappears. Let's go deeper. Professionals build risk systems just like a company builds budgets. They know their monthly drawdown limits, their weekly max exposure, their per-trade risk. They track it, they audit it, they live by it. You want to trade for a living? Then start thinking like a risk manager first and a trader second. Create a dashboard. Know your maximum exposure per position. Know your risk across correlated assets. If you're long on crude oil, maybe you don't need to also be long on oil stocks. Correlation risk is when if you're not watching it, you're setting yourself up for a cascading loss. Track your metrics, your win rate, your average gain, your average loss, your expectancy, your longest drawdown, your average recovery time. This is how you become a trader who treats this like a business. You are not here to gamble. You are here to extract consistent profits from the most competitive financial environment in the world. Let's talk psychology. Risk management is not just about math, it's about emotion. Your brain is not wired to take a loss and feel okay. Evolution taught us to avoid pain at all costs. That's why traders freeze when price goes against them. That's why they remove stops. That's why they double down. They are trying to avoid the pain of being wrong. But cutting a loss is not failure. It's intelligence. It's professionalism. It's an act of control. A trader who can cut losses without emotional disruption is a trader who will outlive 90% of the competition. Create rules, write them down, enforce them. If your stop is hit, you get out. No exceptions. If your drawdown hits 5%, you reduce size. If it hits 10, you stop for the week. Create systems to override emotion. That is the mark of a mature operator. And always remember, the market does not care about you. It does not care how badly you want to recover. It does not care how perfect your setup looks. It will do what it wants. Your job is not to control it. Your job is to control yourself. There is no glory in risking everything. There is no badge of honor for revenge trading. The traders who make it are not the boldest. They are the most consistent, the most cautious, the most in control. In this game of money, survival is the first victory. Wealth comes next, but only to those who stay in the arena long enough to collect it. Before you ever think about making a fortune in the markets, you need to learn how to survive. Most traders fantasize about compounding gains, building wealth, hitting massive winners. Few take the time to master the single most important principle in the business of trading: staying alive. Capital management is not about making money. It's about not losing it recklessly. It's about ensuring that one bad decision doesn't wipe out weeks, months, or years of progress. The truth is harsh. One wrong trade, executed without discipline, can devastate your account far faster than a dozen good trades can repair it. You see it every day. A trader wins 6 trades in a row, each bringing in modest profit. Confidence builds. Caution fades. Then comes the big one, the trade they're sure will be the home run. They increase position size, push the risk boundary, ignore the stop. It turns against them. And it doesn't just erase their gains, it nukes their capital. Weeks of effort gone in a matter of minutes. This is not an anomaly. This is exactly how most accounts get destroyed. Let's talk math. Let's say your account is $100,000. You win 6 trades, each earning $2,000. You're up $12,000. Then you bet big on the next setup, risking 20%, $20,000. It fails. Now your account sits at $92,000. You're not just back where you started, you're worse off. And worse still, your mindset has now shifted. Frustration clouds judgment. That's how traders spiral. Not because they lack intelligence, but because they lack a capital preservation mindset. Professional traders don't think in terms of individual trades. They think in terms of probability distribution over hundreds of trades. Their focus is not on maximizing return, it's on controlling risk per exposure. That's where the 2% rule comes in. It's not a suggestion, it's a survival protocol. The 2% rule simply states, never risk more than 2% of your capital on a single trade. That doesn't mean investing only 2%. It means that your potential loss, calculated based on your stop loss level, should not exceed 2% of your total capital. If your account is $50,000, your maximum risk per trade is $1,000, period. Whether you're trading 1 share or 1,000, the dollar value at risk remains capped. This isn't just about being conservative. It's about statistical resilience. You can have 10 losing trades in a row and still be very much in the game. You can recover from drawdowns without digging yourself out of a financial pit. But most retail traders do the opposite. They scale up when they're emotional. They overtrade to make back what they lost. That's not strategy, that's roulette. Professionals operate like businesses. They don't run on gut feelings. They run on risk models. Their capital is treated like inventory. Their trades are investments, not bets. Every decision is weighed against potential drawdown, variance, and volatility. Let's talk about that word, drawdown. Drawdown is the decline in account equity from the peak to the trough. If your account goes from 100,000 to 90,000, that's a 10% drawdown. But here's where it gets real. In order to recover from that drawdown, you don't need to make 10%. You need to make more, specifically around 11.1%. That's compounding math. And if your drawdown is deeper, say 50%? Now you need to double your account just to get back to even. That's why smart traders avoid deep drawdowns at all costs. They cut losses early. They reduce exposure after a series of losses. They have systems in place that force them to stop trading when certain limits are reached. Not because they're weak, but because they're smart. Which brings us to expectancy, the statistical heartbeat of every trading system. Expectancy tells you how much you can expect to make or lose per trade over the long run. The formula is straightforward. Expectancy equals win rate average win minus loss rate times average loss ta. Let's say you win 40% of the time. Your average win is $2,000. You lose 60% of the time with an average loss of $1,000. Plug it in. 0.4 times 2,000 minus 0.6 times 1,000 equals 800 minus 600 equals 200 tausendwal. That's a positive expectancy of $200 per trade. That's your edge. Over time, if you execute your system consistently, you'll make money. It won't be linear, but it will be sustainable. Expectancy is what separates gamblers from operators. It shifts the focus from outcomes to process. Because you can't control the outcome of any single trade, but you can control your system. You can control your execution. You can control your risk. Now let's talk about risk to reward ratios. This is the leverage inside expectancy. If you risk $1,000 on a trade, your reward should be at least 2 or 3 times that, ideally more. Why? Because it gives you cushion. If your risk to reward is 1 to 3, you only need to win 25 to 30% of your trades to make money. Yet many traders accept one-to-one setups and hope their win rate will carry them. That's a dangerous game, because win rate is volatile. One bad streak and your account starts bleeding. But risk to reward is a controllable variable. You can choose trades with better payoff profiles. You can tighten stops. You can skip trades that don't offer sufficient asymmetry. That's edge thinking. You must internalize this. Cutting a loss is not a failure. It is a professional decision. Too many traders hold on to losers out of ego. They don't want to admit they're wrong, so they wait, and the loss deepens. Then they freeze. Or worse, they average down. They throw good money after bad, thinking they're buying the dip, when in reality, they're compounding stupidity. Professionals don't do that. They respect their stops. They understand that every dollar not lost is a dollar available for the next opportunity. Capital is finite. Opportunity is infinite. You can't exploit the latter if you lose the former. Let's go a step deeper. Capital management must account for volatility. A trade with a wider stop requires a smaller position. That's how you equalize risk across different setups. Don't use fixed share sizes. Use dynamic sizing based on volatility-adjusted stop levels. That's how you scale like a professional. You also need to monitor portfolio risk exposure. If you're long 5 tech stocks, you're not diversified. You're overexposed. If you're trading correlated instruments like gold and gold miners, understand that one move can impact multiple positions. That's correlated risk, and it can crush your account if you're blind to it. Great traders manage capital like hedge fund managers. They don't think in terms of, can I afford this trade? They think in terms of, what percentage of my capital is exposed to correlated risk at this moment? And if the number gets too high, they step back. They track maximum drawdown, volatility-adjusted position size, total exposure, and risk per idea. They run post-trade audits. They maintain heat maps of risk. This isn't paranoia, it's professionalism. Capital management is not just a spreadsheet exercise. It's a mindset, a discipline, a culture. And above all, it's the difference between trading to survive and trading to get lucky. There is no one-size-fits-all strategy in trading. Just as no 2 fingerprints are identical, no 2 traders operate with the same mindset, emotional rhythm, or time availability. The markets are a vast, dynamic arena filled with variables, and trying to trade someone else's system without adaptation is like wearing someone else's suit. It might cover you, but it won't fit right. The key to longevity in trading lies in building a system that is tailor-made to who you are, not who someone else is. The very first step is brutal honesty. You need to assess your personality, your emotional strengths and weaknesses, your lifestyle, and your time constraints. Are you patient or impulsive? Do you handle pressure well? Can you watch markets intraday? Or do you have only evenings to plan trades? These questions are not philosophical, they are foundational. If you have a full time job and can only check charts in the evening, day trading is not for you. That doesn't make you less capable. It just means your system needs to be built around swing trading or position trading. Your time frame defines your data resolution, your stop loss width, your trade duration, and ultimately, your stress profile. A scalper on the 1 minute chart needs split second reflexes and an appetite for adrenaline. A weekly trend follower needs discipline, patience, and an ability to sit through noise. Your system must match your temperament, or you'll abandon it the moment it stops feeling comfortable. Next comes structure. Every professional system answers three non negotiable questions. When do I enter? Where is my stop loss? Where do I take profit? Let's start with entry. Entry is not about getting the lowest low or the highest high. It's about stacking probabilities in your favor. An entry should occur only when a confluence of signals aligns: price action, indicators, and context. For example, if you trade pullbacks in uptrends, you might wait for price to retrace to the 20 exponential moving average, form a bullish engulfing candle, and see confirmation via volume spike. That's structure. It doesn't need to be complex. It needs to be consistent. Entries should be mechanical. If you hesitate, if you second guess, it's because your rules aren't clear. The clearer your entry criteria, the less emotion you'll inject. Now, stop loss. This is your insurance policy. It defines the risk per trade and protects you from catastrophic loss. Never place stops based on a fixed dollar amount. Place them based on the chart, logical invalidation levels. If you're long at a breakout, your stop belongs below the structure that supports that breakout. If that structure breaks, your thesis is wrong. Get out. The beauty of a logical stop is that it serves two roles. It limits loss and tells you when your setup has failed. That's powerful. And take profit. This is where realism meets ambition. Most traders fail here. They either get greedy or exit too soon. A good system defines exit zones before the trade is taken. Use structure, previous highs, Fibonacci levels, or measured move projections. More importantly, use multiple targets. Scale out. Lock in gains. Keep a runner if trend strength remains. By combining these three elements, entry, stop, and target, you frame every trade with clarity and objectivity. There is no room for hope or panic. But how do you know if your entry signal is valid? That's where confirmation comes in. Confirmation is not about adding 20 indicators. It's about finding alignment between different forms of evidence. Price action plus volume, breakouts plus relative strength, trend plus momentum. The point is to reduce false positives. One of the most reliable confirmation techniques is multi-time frame analysis. Suppose your trading setup appears on the hourly chart. Check the 4-hour and daily. Is the higher time frame trend in agreement? If you're trading long against a daily downtrend, your probability drops. If all time frames align, your edge grows. Another confirmation tool is divergence. If price makes a new high, but RSI or MACD makes a lower high, that's bearish divergence, a warning signal. If you see strong price action confirmed by strong volume or a clean pattern, that's positive confirmation. But beware confirmation overload. Don't seek perfection. Look for consensus. 3 solid signals are better than 10 conflicting ones. And remember, the market owes you nothing. Even perfect signals can fail. That's why you always manage risk. Now, even the best system is useless if it isn't optimized. Optimization isn't guessing. It's a data-driven process. And it begins with backtesting. Backtesting means running your system against historical data to evaluate performance. This is where many retail traders cut corners. They glance at a chart and say, it looks like it works. That's not backtesting. That's bias. Proper backtesting involves a rules-based approach. You define exact entry, stop, and target rules. You run those rules over at least 100 trades. You track win rate, average gain, average loss, maximum drawdown, expectancy, and Sharpe ratio. This is how you validate that your system has an edge. Don't curve fit. That means don't optimize your parameters so tightly to past data that they fail in the future. The goal is robustness, not perfection. Once backtesting confirms your system works historically, you move to forward testing or paper trading. Trade your system in real time without risking money. Observe your behavior. Are you following rules? Are you hesitating? Are the results consistent? Once you've passed that stage, you deploy real capital, small at first, and you begin journaling. A trading journal is your accountability mirror. You log every trade, entry reason, stop, target, outcome, emotions, and lessons. Over time, patterns emerge. You'll discover which setups perform best, what market conditions hurt you, and where your discipline cracks. Without a journal, you're trading blind. You're making the same mistakes over and over without realizing it. Journaling isn't optional. It's mandatory for any trader who wants to grow. As your system evolves, so does your identity as a trader. You'll find setups that resonate with your psychology. You'll discard tools that don't add value. You'll develop your own market rhythm. And this is where trading transforms from copying others into becoming a craft of mastery. When your system reflects your strengths, manages your weaknesses, and aligns with your lifestyle, you unlock consistency. You stop chasing. You start executing. You stop hoping. You start expecting. You stop reacting. You start responding. A personalized trading system isn't just a set of rules. It's a strategic framework tailored to you, built on structure, tested with data, and refined through experience. And when that system clicks, you no longer need luck. You have process. And in the markets, process wins over luck every single time. Wall Street is not a playground, it is a battlefield. And the traders who survive, let alone thrive, are not adrenaline junkies or risk-loving gamblers. They are business operators. They run their trading like a company, with structure, discipline, metrics, and continuous performance evaluation. They think like CEOs, because that's what it takes. If you want to move from being a casual speculator to a serious market professional, you must adopt the mindset of a business owner. That means systems. That means accountability. That means running your trading operation with the same rigor as a portfolio manager running hundreds of millions. Whether your account is 5,000 or 5 million, the mindset must be the same. It begins with scheduling your trading like a job, not a hobby. Professionals don't trade when they feel like it. They operate on a calendar. A personalized trading schedule includes pre-market preparation, session execution, post-market review, and weekly reflection. You identify your trading windows, specific hours when you're at your best. You define when to do analysis, when to enter trades, and when to walk away. Consistency in time breeds consistency in execution. Design your daily routine with purpose. Pre-market or pre-session. Analyze key levels, review economic events, assess overnight price action. Market hours. Focus on execution. No distractions, no news browsing, no second guessing. Post-market, journal trades, capture screenshots, analyze performance. Your schedule should include non-trading activities too. Physical training, mental reset, reading, simulation. Why? Because trading performance is linked to lifestyle discipline. A healthy, structured routine outside the markets translates to sharper decisions inside them. Then comes your KPI dashboard, your key performance indicators. Every business tracks numbers. So should you. Your trading KPI might include win rate, risk-reward ratio, average gain versus average loss, number of trades taken per week, percent of trades executed per plan, emotional grade per trade, subjective but powerful, peak to trough drawdown, monthly return, days with optimal focus, you'll know. These metrics are not for show, they're for diagnosis. If your risk-reward drops, why? If your plan adherence falls, why? KPIs turn vague feelings into measurable patterns. They help you detect performance leaks before they sink your results. Next, we tackle what separates amateurs from CEOs, emotional management. Think of yourself as the CEO of a hedge fund. The market is your external environment. Your thoughts are your employees. Some are useful, strategic, informed, calm. Others are lazy, emotional, impulsive. As CEO, your job is to manage them. You don't fire yourself every time your results dip. You coach yourself. You review behavior. You hold yourself to standards. You make decisions based on data, not drama. The biggest threat to consistent trading isn't the market. It's the untrained trader reacting to the market. Your ability to regulate emotion directly impacts your longevity. Establish emotional SOPs, standard operating procedures. After 3 losing trades in a row, pause for 1 hour. If emotionally elevated, walk away and reassess the next day. Meditate or journal for 5 minutes before market open. Use breathing resets during high volatility periods. These aren't hacks, they're systems. They allow your rational mind to remain in control when the primitive mind wants to hijack the wheel. That brings us to one of the most powerful tools in professional trading, the trading journal. This is not a notebook for price levels. It's your secret weapon. A proper journal contains entry and exit screenshots, trade rationale, emotional state at entry and exit, deviations from plan, if any, trade rating, setup quality, execution grade, outcome, post-trade reflection, what went well, what can improve. Over time, your journal becomes a mirror. It shows you your truth. You'll discover that most of your losses are not from bad market conditions, but from poor execution. You'll see that certain emotional patterns precede poor decisions. You'll realize that some setups consistently deliver, while others just look good on the surface. The difference between average and elite traders isn't just talent, it's journaling. The best traders in the world are also the most reflective. They study themselves as much as they study charts. To take it a step further, bring in data analytics. That means turning journal entries into data points. Use spreadsheets or specialized trading software to track, set up success rate, time of day performance, asset class performance, holding time distribution, slippage metrics, emotional impact scores. Data tells stories your emotions can't hide. It reveals your true edge. Maybe you trade best between 9:30 and 11 a.m. Maybe your pullback entries outperform breakout plays. Maybe your performance drops when you trade on Mondays. These insights are pure gold. Data also helps you scale. Once you know where your edge is strongest, you double down. Once you see where losses concentrate, you cut back. You're no longer trading by gut. You're operating from evidence. This is what running a trading business looks like. Daily ops, KPI reviews, emotional protocols, post-trade analytics, weekly reviews, optimization sprints. That's not excessive. It's elite. A true trading business also has risk controls. Max loss per trade, max daily loss limit, max weekly drawdown, circuit breakers, rules that force you to stop, position sizing guidelines. These are your seatbelts. They exist not because you expect to crash, but because you respect the risk of driving fast. Also, build playbooks just like sports teams. Your playbook includes high probability setups you've tested. It includes ideal market conditions. It includes how to manage them in real time. Here's an example. Setup, breakout from consolidation range. Entry, break above range high with 2x volume. Stop, below range low. Target, measured move based on range height. Context, strong market momentum confirmed by sector leader. Confirmation, price holds above breakout on retest. This clarity removes indecision. It allows for automation of judgment. And most importantly, it makes your edge repeatable. Finally, treat yourself like a performance asset. Athletes train. Musicians rehearse. Traders must too. Training means reviewing past trades weekly, practicing with historical charts, running mental rehearsals, visualizing execution, reading performance psychology literature. It means treating your mind like you're trading capital. Protect it, feed it, challenge it. When you run your trading like a business, you don't fear bad days. You study them. You don't chase trades. You plan them. You don't measure success by wins and losses, but by discipline and execution. Be the CEO of your trading desk. Manage capital like cash flow. Manage trades like products. Manage your behavior like a leader. Because in this business, edge without structure is luck. And luck is not a business model. Structure is. Discipline is. Self-mastery is. And that's how real traders win. Not by chance, but by design. Trading is not just about charts and indicators. For those who truly understand the potential of markets, it becomes a path to something greater, financial freedom. But freedom doesn't come from random wins or sporadic hot streaks. It comes from building a long-term strategy where trading becomes the engine, not the destination. The ultimate goal is not to trade forever. The goal is to use trading as a launchpad to create wealth, to invest it wisely, and to turn that wealth into sustainable, self-perpetuating freedom. Financial freedom begins with vision. You must see trading as part of a larger wealth blueprint. Most retail traders fail not because they lack talent, but because they lack a plan. They treat trading as a lottery ticket, not a business. They focus on today's P&L, not the next 10 years. That mindset creates fragile outcomes. A single mistake can wipe them out. So, what does a long-term financial strategy look like in the world of trading? It starts with building your personal financial map. Before you even open a chart, ask, how much capital do I have available for active trading? How much do I need to withdraw monthly to meet living needs, if any? What is my target annual return over 5 years? What's my backup plan if my system underperforms for 6 months? This is not just about spreadsheets. It's about clarity. When you define your capital structure and cash flow goals, you remove the desperation that causes overtrading. You begin thinking like a portfolio strategist, not a gambler. From there, the mission is to transform trading into a sustainable income stream. And that doesn't mean trying to make 10% a week. Sustainability comes from consistency, not heroics. Here's how you do it. Step 1. Determine your monthly income target. This is the base number you need to cover your lifestyle or a portion of it. Let's say it's $5,000 per month. Step 2. Define your average risk per trade. If you're risking 1% per trade, you need to make $5,000 with that model. So, you'll need either a large enough account or a high enough win rate to get there without excessive risk. Step 3. Calculate the required trading capital. With a consistent strategy yielding, say, 4% monthly, you'd need approximately $125,000 in trading capital to sustainably extract $5,000 monthly. If you push for more, you're forcing the market. That's where most fail. This is how professionals think. Not in terms of how much can I make, but what return do I need to live sustainably without compounding risk? As you stabilize your trading income, the next evolution begins, building the 3-layer income pyramid. Layer 1, active trading income. This is where you start. You use your edge to generate consistent cash flow. The goal here is not to get rich overnight. The goal is to build the muscle of execution, discipline, and risk management. Active trading teaches you how to handle capital with precision, but it's time-intensive, it's emotionally demanding, and it doesn't scale well forever, which is why Layer 2 matters. Layer 2, passive investment growth. Take a percentage of your trading profits and invest them in long-term vehicles, ETFs, real estate, dividend stocks, or private businesses. The objective here is capital growth with lower emotional volatility. Unlike trading, investments don't require constant monitoring. They work while you sleep. This layer diversifies your exposure and begins creating real wealth, not just income. Layer 3, reinvested compound returns. This is where the magic happens. Profits from Layer 1 fuel Layer 2. Profits from Layer 2 are reinvested, accelerating growth. Over time, your capital compounds geometrically. Instead of withdrawing all trading profits, you recycle them into assets that appreciate and generate yield. You go from income to empire. This triple-layer strategy turns trading from a hustle into a wealth engine. But structure alone is not enough. You must also evolve your identity. To trade for financial freedom, you must become more than a trader. You must become a capital allocator. Capital allocators don't chase markets. They deploy resources. They manage liquidity. They think in terms of opportunity cost, expected value, risk exposure, tax efficiency, and strategic diversification. Their focus is not just making money, but protecting it, growing it, and giving it direction. This shift in identity transforms how you view the game. You stop needing action. You start needing asymmetry, low risk, high reward. You stop asking, can I trade today? And start asking, is this the best use of my capital today? You also start thinking in time horizons. 1-week outlook, tactical trades, 1-year outlook, investment themes, 10-year outlook, legacy capital say. The day you start thinking in decades is the day you start playing the real game. Trading for freedom also requires lifestyle design. What does your ideal life look like? Do you want geographic freedom, time freedom, creative freedom? Define it. Because financial freedom is meaningless without lifestyle alignment. Many traders build profitable systems but trap themselves in 20 monitor setups and endless screen time. That's not freedom. That's a golden cage. If your trading life isn't giving you the time, health, and joy you envisioned, it's time to redesign the system. Automate more. Delegate more. Simplify strategies. Reduce trade frequency. Optimize screen time around results, not activity. Use alerts. Build dashboards. Create trading that serves life, not the other way around. Another pillar is risk scaling. As your capital grows, your strategy must evolve. What works for a $20,000 account may not work for a $2 million account. Liquidity, slippage, volatility tolerance all shift. You must learn capital segmentation. Divide capital into buckets: core trading capital, reserve emergency capital, long-term investment capital, opportunity capital for high conviction plays. Each bucket has different rules, different risk profiles, different expectations. This segmentation protects your freedom. It ensures that one bad streak in active trading doesn't derail your long-term vision. To support this evolution, surround yourself with a financial freedom ecosystem. Mentors who think bigger than you, tax strategists, asset protection lawyers, business coaches, performance psychologists. Trading for financial freedom is not a solo mission. Build a board of directors for your money. Learn from those who've scaled from thousands to millions. Don't just seek edge in charts, seek edge in capital management. Finally, track your freedom metrics, not just your trading metrics. How many days per month do you control your time? How many income streams are active without your direct input? How many assets are appreciating without active monitoring? What percentage of your income is passive versus active? These are the numbers that matter, because freedom isn't just about money. It's about what money gives you access to: choice, time, autonomy, contribution. If you use trading to buy back your time, you're winning. If you use trading to build legacy assets, you're playing the long game. If you use trading to control your lifestyle instead of being controlled by it, you're free. And that is the ultimate trader transformation. You start as a chart reader, you become a strategist, you evolve into a capital allocator, and one day you wake up not needing to trade, but choosing to, on your terms, in your time, for your reasons. That is financial freedom, not someday, not maybe, but by design, by process, by intelligent, deliberate intent. Most people come to the market chasing quick profits. But those who last, those who rise, realize something deeper. Trading is not just about money, it's about mastery. It's about building yourself into the kind of person who can thrive in chaos, make decisions under pressure, and operate with clarity in a world of noise. What you've just read is not a typical trading book. It's a blueprint for turning trading into a profession, a system, a lifestyle, and ultimately, a bridge to financial freedom. You've learned how to think like a trader, manage risk like a hedge fund, and operate like a CEO. You've seen how trading is not an endgame, but a launchpad to wealth, to freedom, and to personal power. But this is only the beginning. The market doesn't reward those who show up once. It rewards those who evolve, who show up every day with a sharper mindset, a stronger edge, and deeper discipline. Consistency is your weapon. Structure is your armor. Mindset is your edge. So as you step into the next chapter of your journey, whether you're still learning or already earning, do it with intention. Build your system, track your data, master your emotions, and never stop refining your process. Because in this game, the ultimate goal is not to beat the market. It's to master yourself. And if you're serious about that journey, if you're done with hype, noise, and empty promises, then I invite you to go one step further. Join us at Trading Mindset Lab. It's more than just a channel. It's a lab where real traders get built, where we dive deep into the psychology, discipline, and strategy that separates amateurs from professionals, where we focus not just on how to trade, but how to think, how to grow, and how to win on your own terms. If this message resonates with you, don't just walk away inspired. Take action, subscribe, tap the bell, join the movement. Every week, you'll get powerful tools, frameworks, and insights to help you level up your game, mentally, strategically, financially. Because trading is not a job, it's not a hobby, it's a craft. It's a business. It's a path. And if you're ready to walk it, you don't have to walk alone. Welcome to Trading Mindset Lab, where traders get built.